The American monetary system orchestrates the creation, circulation, and valuation of money, serving as the backbone of a $150 to $200 trillion economy. Since its formal establishment with the First Bank of the United States in 1791, the system has evolved from a patchwork of localized banking to a centralized framework managed by the Federal Reserve and supported by the U.S. Treasury. At its core, fractional reserve banking enables banks to create money through lending, driving economic activity while navigating challenges such as debt accumulation and market fluctuations. In January 2025, the money supply, measured as M2, stands at $21,560 billion, reflecting centuries of financial innovation and growth. This essay provides a clear, factual, and comprehensive analysis of the system's mechanics, tracing its historical development, detailing money creation and circulation, examining the roles of the Federal Reserve and U.S. Treasury, and exploring currency valuation and revenue generation. Historical milestones, from the first bank's standardized notes to the 1913 Federal Reserve Act and the 1971 shift to a fiat system, contextualize its evolution, while current data, such as the $45,560 billion federal debt in 2024, highlight its scale. The system's complexity, balancing economic growth with stability, makes it a vital engine for the nation's prosperity, and this narrative aims to demystify its operations for a broad audience. In the pre-1791 era, local banks issued notes backed by gold or silver, limited to community use and vulnerable to counterfeiting, constraining the money supply to $10 to $15 million. The first bank introduced fractional reserve banking, creating money through loans and fostering trust with uniform notes. The Federal Reserve, established in 1913, resolved the instability of the 1836 to 1913 period, standardizing currency and expanding the money supply to $20 billion by 1913. The 1971 transition to a fiat system, ending the gold standard at $35 per ounce, enabled flexibility for a globalized economy. Today, the Federal Reserve manages interest rates set at 4.75% to 5% in 2025 and bond purchases, supporting a $1,900 billion deficit. The U.S. Treasury prints currency, collects $5 trillion in taxes, and issues bonds, ensuring liquidity and stability. This essay explores these dynamics across 4 parts: historical development, money creation and circulation, institutional roles, and currency valuation with revenue generation, using arrow diagrams to clarify processes and providing a comprehensive, engaging narrative of the system's operations. Part 1. Historical development of the U.S. monetary system. The American monetary system's historical development reflects a transformative journey from fragmented, community-based banking to a centralized framework capable of supporting a $150 to $200 trillion economy. Before 1791, banking in the United States was localized, with community banks serving as secure vaults for gold, silver, and property deeds. These institutions issued their own notes, typically backed by precious metals, but these were accepted primarily within local communities, limiting their utility as trade and travel expanded across regions. The money supply during this period was constrained, estimated at $10 to $15 million, and lending was minimal, focused on trade, land speculation, or small businesses like mills and shops. Many Americans homesteaded without loans, relying on self-sufficiency in the frontier economy, which reduced the need for borrowing but hindered broader economic integration due to the lack of a uniform currency. Local banknotes were often unreliable, vulnerable to counterfeiting, and lacked trust outside their issuing communities, creating inefficiencies in commerce and necessitating a more cohesive financial system. In 1791, the First Bank of the United States, established in Philadelphia, marked a pivotal shift by introducing fractional reserve banking, a system that allowed banks to lend beyond their reserves, typically holding 10% as cash or precious metals. This enabled banks to create new money by crediting borrowers' accounts, expanding the economy beyond the limitations of physical reserves. The first bank issued standardized banknotes, convertible to gold or silver, which were more trusted than local notes, facilitating transactions across regions and fostering economic stability. Local banks deposited assets, such as gold or silver, with the first bank, receiving its notes or credit, which they used for lending or transactions, enhancing the system's reliability. Despite its success in stabilizing the young nation's economy, the first bank faced political opposition, particularly from advocates of states' rights who distrusted centralized authority, leading to the expiration of its charter in 1811. The Second Bank of the United States, chartered in 1816, continued these functions, managing government funds and issuing uniform currency to further integrate the economy. It played a critical role in handling federal finances and stabilizing markets, but like its predecessor, it encountered resistance, notably from President Andrew Jackson, who viewed it as an overreach of federal power. The Second Bank's charter ended in 1836, plunging the U.S. into a period of financial disarray from 1836 to 1913, during which thousands of state-chartered banks issued their own notes. This proliferation led to rampant counterfeiting, inconsistent valuations, and frequent financial panics, such as those in the 1870s and 1890s, which disrupted trade and eroded public confidence. The money supply grew chaotically, reaching $20 billion by 1913, but the lack of centralized oversight underscored the need for a more robust system. The Federal Reserve Act of 1913 established the Federal Reserve, marking a turning point in American monetary history. The Fed standardized currency with Federal Reserve notes, replacing the patchwork of state banknotes, and provided regulatory oversight to prevent financial instability. By 1913, the money supply had expanded to $20 billion, reflecting the growth of banking and commerce. The Fed's creation addressed the inefficiencies of the pre-1913 era, ensuring a uniform currency that facilitated trade across the nation and laid the foundation for modern monetary policy. The shift to a fiat system in 1971, ending the gold standard where the dollar was valued at $35 per ounce, introduced greater flexibility, allowing the money supply to grow to $21,560 billion by 2025. This transition accommodated the demands of a globalized economy, where digital transactions and international trade required a currency untied from finite commodities like gold or silver. The evolution from localized to centralized banking addressed critical challenges, including counterfeiting, mistrust, and economic fragmentation, enabling the system to support a $150 to $200 trillion economy. The first bank's introduction of standardized notes reduced fraud, while the Federal Reserve's establishment resolved the instability of the 1836 to 1913 period, fostering trust and reliability. The fiat system's flexibility supports modern commerce, but requires careful management to avoid volatility, setting the stage for understanding the mechanics of money creation and circulation, as well as the roles of key institutions in sustaining this dynamic system. Part 2. Money Creation and Circulation. The American monetary system relies on fractional reserve banking to create and circulate money, a process that drives economic activity and generates significant tax revenue to fund government operations. In this system, banks are permitted to lend beyond their reserves, typically holding 10% as required by the Federal Reserve, creating new money in the form of deposits. When an individual secures a $100,000 mortgage to purchase a house, the bank credits their account with a deposit, which constitutes new money, not drawn from existing cash reserves. The borrower spends this money by transferring it to the seller, such as a homeowner, who then deposits it into their own bank account. The seller's bank retains $10,000 as reserves and lends out the remaining $90,000, creating another deposit in a new borrower's account. This cycle of lending and depositing can multiply an initial $100,000 loan into $1 million, significantly expanding the money supply, which reached $21,560 billion in January 2025, according to the M2 measure, encompassing cash, checking accounts, and savings. This money creation process applies to both real property, such as land or houses within the $48,200 billion real estate sector, and consumable goods, like a $1 purchase of bubblegum using a credit card. Real property loans are secured by tangible assets, allowing banks to repossess the property if the borrower defaults, which provides a degree of financial stability. For example, a mortgage on a house valued at $300,000 is backed by the property's market value, which may appreciate over time, reinforcing the loan's security. In contrast, consumable loans, such as those for food or small retail purchases, are unsecured, relying solely on the borrower's promise to repay, which introduces higher risks of default and potential inflationary pressure if lending is excessive. The cumulative effect of lending across these categories is evident in the $20.4 trillion household debt and $21.6 trillion business debt recorded in 2024, reflecting the scale of money creation in the economy. Once created, money circulates through a multitude of transactions, fueling economic growth and generating substantial tax revenue, which amounted to $5 trillion in 2024. These transactions include wages paid to workers, payments to suppliers for goods and services, and consumer purchases ranging from groceries to vehicles. Banks amplify this circulation by re-lending deposited funds, creating additional deposits that further expand the money supply. The Federal Reserve manages this flow through monetary policy tools, including setting interest rates, which were between 4.75% and 5% in 2025, and conducting open market operations. By purchasing U.S. Treasury securities, the Fed credits bank reserve accounts, injecting new money into the economy to support the $45.560 trillion federal debt. These purchases stabilize financial markets by maintaining bond prices, preventing banks from selling securities at a loss, and ensuring liquidity for lending and spending activities. The global circulation of the dollar, with $8 trillion held in foreign reserves, underscores its role as a cornerstone of international trade and finance. However, excessive money creation, particularly through unsecured loans for consumables, can lead to inflation, reducing the dollar's purchasing power, as observed during the price spikes of 2022 to 2023. The Federal Reserve's oversight is critical to balancing this risk, ensuring that money creation aligns with the economy's productive capacity, the maximum output of goods and services it can sustain. Historical parallels, such as the chaotic proliferation of local banknotes during the 1836 to 1913 period without a central bank, highlight the instability that can arise from unchecked money creation. The introduction of fractional reserve banking by the first bank in 1791 laid the groundwork for this system, but it was the Federal Reserve's establishment in 1913 that provided the centralized management necessary to prevent such instability, ensuring efficient money flow. The dynamism of money creation and circulation drives economic expansion, enabling businesses to invest, consumers to spend, and governments to collect taxes for public services. However, it requires careful regulation to avoid overlending, which can destabilize markets, as seen in the 2008 housing crisis driven by excessive mortgage lending. The interplay of lending, spending, and Federal Reserve oversight ensures that money circulates effectively, supporting a robust economy while addressing the inherent risks of fractional reserve banking. This process is intricately linked to the roles of the Federal Reserve and U.S. Treasury, which manage currency issuance, debt, and monetary policy to sustain this cycle of economic activity. Part 3. Roles of the Federal Reserve and U.S. Treasury. The Federal Reserve and the U.S. Treasury are central pillars of the American monetary system, collaborating to manage currency issuance, debt, and economic stability, ensuring the smooth operation of a $150 to $200 trillion economy. The Federal Reserve, established through the Federal Reserve Act of 1913, serves as the nation's central bank, with a mandate to regulate commercial banks, set monetary policy, and stabilize financial markets. It oversees the fractional reserve banking system, which allows banks to lend beyond their reserves, typically holding 10% as mandated, creating a $21.560 trillion money supply in January 2025. The Fed sets interest rates, fixed at 4.75% to 5% in 2025, to influence borrowing costs and economic activity, encouraging lending during slowdowns or tightening to curb inflation. Through open market operations, conducted by the Federal Open Market Committee, the Fed purchases U.S. Treasury securities, crediting bank reserve accounts to inject new money into the economy, supporting the $45.560 trillion federal debt and stabilizing bond markets by preventing sell-offs at a loss. The Federal Reserve generates substantial revenue to fund its operations, primarily through interest earned on its portfolio of Treasury securities, agency debt, and mortgage-backed securities. For instance, a $1 billion Treasury bond yielding 4% generates $40 million in annual interest, constituting over 90% of the Fed's income. Additional revenue streams include fees for financial services, such as check clearing, automated clearinghouse transfers, FedWire funds transfers, and the FedNow instant payment system, which collectively generated $500 million in 2023. The Fed also earns interest on discount window loans, serving as a lender of last resort to banks facing liquidity shortages, and on foreign currency investments, reflecting the dollar's global role with $8 trillion held in foreign reserves. These revenues fund operational costs, including $1.1 billion in employee salaries, $1 billion for currency production, and $700 million for the Consumer Financial Protection Bureau in 2023. After covering expenses and paying $1.5 billion in statutory dividends to member banks, the Fed remits excess earnings to the U.S. Treasury, contributing to the $5 trillion in federal revenue in 2024 and reducing the $1.9 trillion deficit. The U.S. Treasury complements the Federal Reserve's role by managing the physical production of currency and fiscal operations. The Bureau of Engraving and Printing, under the Treasury, produces Federal Reserve notes at a cost of $1 billion in 2023, ensuring banks have sufficient cash to meet public demand for withdrawals and transactions, a small fraction of the digital money supply. The Treasury's Secret Service plays a critical role in combating counterfeiting, maintaining public trust in the dollar's integrity, which is essential for its acceptance in domestic and international markets. The Internal Revenue Service, another Treasury component, collects taxes, generating $5 trillion in 2024, which funds government programs such as infrastructure, defense, and social services. However, when tax revenue falls short of federal spending, resulting in a $1.9 trillion deficit, the Treasury issues bonds, notes, bills, and bonds to borrow funds from banks, individuals, and the Federal Reserve. These bonds, part of the $45.560 billion federal debt, finance public services and ensure fiscal continuity. The Federal Reserve structure is a unique hybrid of public and private elements, designed to balance independence with accountability. The Board of Governors, a federal agency, consists of 7 members appointed by the President and confirmed by the Senate, overseeing national monetary policy and regulatory functions. The 12 regional Federal Reserve banks, structured like private corporations, are owned by member banks, which hold stock and receive 6% dividends, totaling $1.5 billion in 2023. This hybrid model, established in 1913, allows the Fed to operate without congressional funding, relying on its revenue to cover expenses. Oversight is provided through congressional hearings, Government Accountability Office audits of non-monetary operations, and public disclosures like the Fed's annual report and weekly balance sheets, though monetary policy decisions are exempt from direct audit, sparking debate over transparency. The collaboration between the Fed and Treasury, rooted in their complementary roles, ensures liquidity, currency reliability, and economic stability, replacing the chaotic banking environment of 1836 to 1913 and supporting modern financial demands. The partnership between the Federal Reserve and the U.S. Treasury is critical to the monetary system's success, integrating monetary policy with fiscal operations to sustain economic fluidity. The Fed's management of interest rates, bond purchases, and currency supply, combined with the Treasury's currency production, tax collection, and debt issuance, forms a cohesive framework that drives the economy. This interplay, built on the foundation of the 1913 Act, addresses historical challenges like counterfeiting and instability, ensuring the system can support a globalized economy while navigating the complexities of modern finance. Understanding these roles provides insight into the broader dynamics of currency valuation and revenue generation, which are essential to the monetary system's operation. Part 4. Currency Valuation and Revenue Generation. The valuation of the U.S. dollar, a critical component of the American monetary system, depends on the interplay of supply, demand, and global trust, shaping its role in a $150 to $200 trillion economy. Since the end of the gold standard in 1971, when the dollar was valued at $35 per ounce of gold, its worth has been determined by market dynamics rather than a fixed commodity. The Federal Reserve manages this valuation through monetary policy tools, including setting interest rates at 4.75% to 5% in 2025 and conducting open market operations by purchasing U.S. Treasury securities. These purchases, crediting bank reserve accounts, inject money into the economy, supporting the $45,560 billion federal debt and stabilizing bond markets by preventing sell-offs at a loss. The dollar's global prominence, with $8 trillion held in foreign reserves, reinforces its value, but excessive money creation can lead to inflation, reducing purchasing power, as observed during the price spikes of 2022 to 2023. The money supply, measured as M2 at $21,560 billion in 2025, reflects the cumulative effect of fractional reserve banking, where banks create money through loans for both real property and consumable goods. Real property loans, such as mortgages for houses within the $48,200 billion real estate sector, are secured by tangible assets, providing stability as banks can repossess property in case of default. Consumable loans, like a $1 credit card purchase for bubblegum, are unsecured, relying on repayment promises and carrying higher risks of contributing to inflation if overextended. The scale of lending is evident in the $20,400 billion household debt and $21,600 billion business debt in 2024, which drive economic transactions but require careful management to avoid destabilizing markets, as seen in the 2008 housing crisis triggered by excessive mortgage lending. The Federal Reserve generates revenue to fund its operations, ensuring it remains independent of congressional funding. The primary revenue source is interest on securities, including Treasury bonds, agency debt, and mortgage-backed securities, which constitute over 90% of its income. For example, a $1 billion Treasury bond yielding 4% generates $40 million in annual interest, a significant contribution to the Fed's finances. Additional revenue comes from fees for financial services, such as check clearing, automated clearinghouse transfers, FedWire funds transfers, and the FedNow instant payment system, which collectively earned $500 million in 2023. The Fed also earns interest on discount window loans, provided to depository institutions facing liquidity shortages, and on foreign currency investments, reflecting the dollar's role in a $100 to $115 trillion global money supply. These revenues fund operational costs, including $1,100 million in employee salaries, $1 billion for currency production, and $700 million for the Consumer Financial Protection Bureau in 2023. After covering expenses and paying $1,500 million in statutory dividends to member banks, the Federal Reserve remits excess earnings to the U.S. Treasury, contributing to the $5 trillion in federal revenue in 2024 and reducing the $1,900 billion deficit. This remittance supports public programs, from infrastructure to defense, benefiting taxpayers indirectly. The Fed's revenue is stored digitally as securities and reserve balances, with gold holdings, valued at $42.22 per ounce in 2025, playing a minimal role compared to electronic assets. The Fed's hybrid structure, with a public board of governors and privately structured regional reserve banks, allows it to generate and manage revenue independently, though congressional oversight through hearings and audits ensures accountability. However, exemptions for monetary policy decisions spark debate over transparency, as the public sees aggregate figures but not detailed transaction data. Market fluctuations, such as the 2008 housing crisis, highlight the challenges of maintaining currency stability, requiring Federal Reserve intervention to balance growth and inflation. The dollar's value depends on confidence, supported by its global role, but risks from overlending or external factors, like trade imbalances, necessitate vigilant management. The Fed's revenue generation and currency valuation efforts are integral to sustaining economic stability, ensuring the dollar remains a trusted medium in domestic and international markets. Conclusion. The American monetary system, a complex and dynamic framework, orchestrates the creation, circulation, and valuation of money, sustaining a $150 to $200 trillion economy. Its historical evolution, from the localized banks of 1791 to the centralized structure under the Federal Reserve established in 1913, reflects a response to the inefficiencies of diverse, counterfeit-prone banknotes. The first bank of 1791 introduced fractional reserve banking, enabling money creation through loans and standardizing currency, while the Federal Reserve Act resolved the instability of the 1836 to 1913 period, expanding the money supply to $20 billion by 1913. The 1971 shift to a fiat system, ending the gold standard at $35 per ounce, provided flexibility to support a globalized economy, culminating in a $21,560 billion money supply in 2025. Fractional reserve banking drives this system, allowing banks to create money through loans for real property, like the $48,200 billion real estate sector, and consumables, such as a $1 bubblegum purchase. These loans generate $20,400 billion household debt and $21,600 billion business debt, fueling transactions that produce $5 trillion in tax revenue in 2024. The Federal Reserve, setting interest rates at 4.75% to 5% in 2025, manages this process through bond purchases, supporting the $45,560 billion federal debt and stabilizing markets. The U.S. Treasury complements this by printing currency, combating counterfeiting, and collecting taxes, while issuing bonds to fund a $1,900 billion deficit, ensuring economic liquidity. The dollar's value, untied from gold, depends on global trust, with $8 trillion in foreign reserves, but faces risks from inflation and market fluctuations, as seen in the 2008 housing crisis. The Federal Reserve generates revenue from securities interest, fees, loans, and foreign currency investments, funding operations like $1,100 million salaries and remitting excess to the Treasury. Operating within a $100 to $115 trillion global money supply, the Fed's revenue practices are critical to maintaining stability. This system, while complex, adapts to modern demands, balancing growth with reliability. Future challenges require vigilant management to ensure the dollar remains a trusted cornerstone of global finance, supporting economic prosperity and public welfare through a robust, evolving monetary framework. Addendum: the evolution and projections of the U.S. money supply. The U.S. money supply, a fundamental component of the nation's economic infrastructure, has experienced significant growth since the inception of its formalized financial system, reflecting the expansion of economic activity and monetary policy innovation. In the pre-1791 period, the monetary base was modest, estimated at $10 to $15 million, consisting primarily of physical coins and notes issued by local banking entities. The establishment of the First Bank of the United States in 1791 initiated a structured increase, with the money supply reaching approximately $20 billion by 1913 following the creation of the Federal Reserve. The transition to a fiat system in 1971, moving away from the gold standard valued at $35 per ounce, facilitated greater flexibility, elevating the money supply to $21,560 billion in January 2025, encompassing cash reserves, transactional accounts, and savings instruments. Historical data illustrates a steady progression, with the monetary base growing from $4 trillion in 2000 to $21 trillion by 2024, indicative of robust policy responses. A notable acceleration occurred between 2020 and 2022, when economic stimulus and central bank interventions added approximately $6 trillion, raising the supply from $15 trillion to over $21 trillion. Economic analyses suggest that nearly 60% of this total has accumulated since 2008, expanding from $5 trillion in 2002 to $20 trillion by 2023, driven by measures to support economic stability and growth. Looking ahead, the future trajectory of the money supply warrants careful consideration. The rapid expansion, surpassing the economy's productive capacity, raises questions about potential inflationary pressures, as observed in price adjustments during 2022 to 2023. Projections indicate that a return to pre-2020 levels might require a reduction of $3 trillion, a significant adjustment given the $45,560 billion debt burden in 2024. Alternatively, a modest contraction, as suggested by a negative growth rate in 2023, could signal economic recalibration, with a 3.9% annual increase in 2025 offering a measured outlook. Supported by $8 trillion in foreign reserves, the currency's global position remains robust, though ongoing monitoring is essential to maintain its value amidst international economic dynamics and domestic policy shifts.